Okay. Good afternoon, everyone, and welcome. I'm delighted that you're here. My name is Ann Plechner, and I have had the pleasure of being on the Women Founders Board for now 12 years. This is our 13th year since we started. Women Founders Network is a nonprofit organization dedicated to helping women entrepreneurs. And we do so in a variety of ways. We have a lot of educational programs, like today is one of our many webinars for women entrepreneurs. We also hold events where women entrepreneurs can meet each other, they can meet investors, and they can create a community and not feel like they're the Lone Ranger. And then finally, we have our fast pitch competition, and applications are now open through the end of May for the fast pitch. And if you have an interest, or maybe if you don't even know what a fast pitch competition is, go to our website and check it out, because this year's winners of our fast pitch competition will be awarded $55,000 in cash. We don't ask for equity. We are awarding $55,000 to the winners of the fast pitch competition. And we will select 5 companies to compete in the tech area and 5 companies in kind of the non-tech area. And those top 10 applicants will get pitch coaches and financial mentors and just a lot of support, so that by the time they pitch at the final event in October, they are absolutely pitch perfect, which is now a movie, so I shouldn't be using the term, but they truly are. So 13 years ago, we decided we needed to do something to help women on their journey. But about 9 or 10 years ago, we also decided that one of the main problems and struggles that women entrepreneurs have is that there are very few women in venture capital, in valuation, and who are starting big, successful companies. So we started what we call our Next Gen programs. We have an educational program for high school girls and an educational program for college women on due diligence, on business fundamentals, and on looking at our top 10 and figuring out, why is one company going to succeed over the next? Because if we start educating girls at that age and having them a little bit more aware of financial literacy and investing, then we feel that helps their road in the future to success and to independence. So if you know girls in high school or women in college who might want to participate in our programs, we're running out of time. The applications are due next week, so check it out. It's a wonderful program. Okay, back to education. Today's webinar is one of my favorite topics, but of course I came from finance and accounting, so I do have a bias. But we are talking about today how to create a financial forecast. Not so easy when you're a startup. Not so easy when you don't have years and years of historical financials to help you forecast the future. But rest assured, I have 2 experts here today from KPMG that will teach you everything that you need to know. And we do hope that you ask questions. If you can, put your questions in the question section down below in the Q&A. And your comments can go in the comments section. We will try to get to all of those at the end. So from KPMG, ladies, I will allow you to introduce yourself, but please welcome Chloe Hazan and Veronica Lin.
Thank you so much, Anne. My name is Veronica Lin. I'm a senior manager at KPMG Alternative Investment Valuation Team. And I've been with the firm for about 16 years. I specialize in business valuation and primarily focusing on portfolio mark-to-market valuations. So as part of my day-to-day job, I have a lot of interaction with the fund CFOs, controllers, with the portfolio companies, and the investment teams to discuss the business forecast. So I can help them to determine the value of their investments. I'm very excited to be here today to discuss the topic and share my experience with you. And with me as Chloe, do you want to give the team, everybody a quick introduction of yourself?
Sure. My name is Chloe Hazen. I'm a senior manager at KPMG in the Valuation and Business Modeling Services practice. I've been with KPMG for about 10 years now and had 3 years at a smaller boutique firm, all doing business valuation and intangible asset valuation. Kind of like Veronica, we spend a lot of time with clients analyzing historical and projected financial information as part of our daily job, and look forward to sharing with you some tips and tricks for developing your own forecasts. So back to Veronica.
Thank you, Chloe. And just a reminder, like I mentioned, like if you do have any questions through the sessions, feel free to pop them into the Q&A section, and we will monitor them and then we'll answer that at the end of the session. So today we will be discussing how to develop your financial forecast and some key elements you will consider for your pitch book. This is a very important step as it is often the first aspect any investors evaluate your business case. So the financial feasibility and the potential of your business. So it's turning your big idea and dream into tangible figures that can provide your prospective investors with a better understanding of their return on the investments. So the focus is so important as it is provide investor a starting point to monetize your innovative idea, calculate their returns, and determine how much money they would like to put into your business and to bring your idea to life. But as you know, it can be very tricky. The first challenge you face here is common to all the startups, is that you have no historical financials. Many companies, I can tell you that even for sophisticated financial institutions I've been working with to find this task to be very challenging, and you are definitely not alone. For more established companies, forecasts can generally be based off a starting point, mostly actual historical numbers. So let's say if you are going to do next 12 months forecast, you started from last year's actual result, then you bifurcate one-time or recurring assumptions that you can carry them over into your next year forecast. And then layer in some sort of growth metrics or macro market trends based on your research. It has been said startups face a unique challenge here, that you don't have the actual financial data you know of. You don't have any historical data to base your focus off. Even you are not the first year in the business, your historical actual result could be very different from the future. So your historical data is somewhat irrelevant for your forecast. So really here you are starting from scratch. Where is the best place to start in putting pen and paper and coming up with something meaningful? So that's the topic we are going to cover today. So before we discuss how to build up a forecast, let's first talk about what the investors are looking for. Remember, different investors have different investment strategies, each with very different level of risk tolerance and expected return. And I'd like to take a moment to explain business life cycle here, so you know what your investors are looking for, so you can prepare the information and the answer they are looking for. So on the left side of the chart, while a company is in the ramp-up phase with very limited revenue and negative profit, venture capital investors, that's where the venture capital investors come in. So they usually invest in this type of early stage company to provide a relatively small amount of launch capital in exchange for any ownership stake in the company. So they usually make small money, but very diversified investment and expecting the upside from one or two of their unicorn investments. And when we start to move to the right of this chart, the business cycle, when the companies start to grow significantly and generate positive cash flows, investors in the growth fund, growth equity fund, or buyout fund are looking to speed up the growth and improve the profitability through some type of transformational events. These investors are willing to invest larger dollar amount with a higher valuation, and what they are seeking for is major control to exit the company through mergers or IPOs. So I believe majority of
Veronica,
you,
can I interrupt for just a moment? Chloe, is there a way to make those slides any bigger? Maybe reduce the view of the speakers, or we got a comment that the slides are harder to see.
Is that better? Sorry, I don't know if there isn't a way to make it bigger than it
Somebody
currently.
said Control L might work.
Yeah, I mean, I can like zoom in, but then I don't think you could see the full slide.
Okay, somebody said that's somebody said they can zoom in from their end, and other people are saying that's better. Okay, thank you. Sorry, Veronica, keep going.
yep. So I think majority of you are in this chart on the left side of the chart, and you may not have started or generate revenue yet, or even you have very minimal revenue. You are pretty much just like seeking to the growth opportunity of maximize your profitabilities. So in other words, you're in the phase of burning money, then generating money. So you have a question, you probably have a question here. So if you have more cash out than cash in, where the value of your company comes from, right? So it's all driven by your future cash flows. So that's why forecast could play such an important role for your investors. So that's going back to what your investors are looking for early stage companies like you. I think that can layer down into 3 questions. First, how much potential there is, how big your pie will grow. Second, how long it will take you for your company to start generating revenue. And the third, how much capitals you need before you reach your break-even point. So make sure your forecasts are developing, have answer to tell all the 3 questions. So we can move on to the next slide. So I think I saw a question pop out. So I will repeat those 3 questions again. So the first question is how much potential there is, how big your pie will grow. Second question, how long it will take for your company to start generating revenue. The third question is how much capitals, how much money you need before you reach your break-even. So those are the 3 questions. Okay, so I'll move on to the next slide. So how to create a forecast in an early life cycle. So as I mentioned earlier, in the early life cycle of your business, you have very limited available historical financials to analyze. So how are you supposed to create a financial plan for something that doesn't even exist? So let me tell you this. Because you don't have any historical data, it kind of sets you free. You don't have to be a CPA or financial expert. You don't need to build up your forecast based on any like accounting standard. You just do everything on cash basis. So remember cash in and cash out. That's what your investors are looking for. Do a simple math. Most important thing here is align your business plan with your forecast. So we know ultimate goal for a company to survive is to be profitable. And so that should be a milestone you should consider in your forecast. So the suggestion is you can try your milestone in the following phases, like we list down in the slide. Preparation, setup phase. How much money you need to get the company started. Second, lead generation. How much more money you will need to keep the company alive until the first customers buy a product, so you can start to generate your first revenue. less business development. How much money you will be needed to keep the company afloat until there are enough customers to pay your bills and make the company profitable. That means that you can start your financial plan by listing out all the relevant expenses that require to go through these 3 steps. So let's think about this. List out things that you need to do in order to get your company started. Maybe a store to find, a website to create, a product to design and ready for sale. So in any case, that means that there are things you need to do or bills you need to pay even before you get to meet your first customers, right? So you have to keep those costs in mind. So keep in mind for a startup preparing a business plan, it's less about realistic picture of what will happen, but more about what needs to happen in order to keep the company survive. So once you know that, you need to make a strong statement. How much time will you take before you become profitable and see more cash coming in than cash coming out? And there's no one truth about the time, but you can think about 18 months to 2 years should be a good time frame. You can decide to have a longer time frame before it happens. But of course, that will just increase the amount of the money you need. You have to pay out of your pocket or through the investors. And of course, some companies require more or less time to achieve profitability. If you take the example of 2 years time frame, that means like you need money 24 months down the road when you start to see the gross margin equal to your expenses. That's when you become break even. So I want to talk about 2 techniques here that you can consider when you build up your financial forecast: bottom up and top down. And I can explain how you can use.
Can I just interject? We do also have a webinar on how to create a pitch deck. And that webinar, I think, was about a week ago. So it should be on our website. And it'll talk about how you generate your first revenues by how you do a marketing plan to get your first customers. So I encourage everyone to look into that because it will help you to come up with a revenue number even to start with, because it'll talk about how are you going to capture your customers, how are you going to get your brand out there, your name out there, and your product out there so people even know you exist. And then you can use that to figure out how many customers you might get in the future. Sorry. Go ahead.
Yeah, I saw some very positive feedback from the comments below, so definitely take a look on that webinar. So like I mentioned, there are 2 techniques. So I'll explain to you how to use these techniques for different forecasting purposes. So first, start smart and short term. So like the 18 to 24 months that we just talked about. For this short term projections, we suggest considering bottom up. So think about the milestone we just talked about. You list out all the detailed costs required to sell your first product or reach your break even. And for all the costs you consider, you have to take the dollar amount or time into consideration. So for example, how much money you need to rent an office and how long you need to keep the office before you start to generate the revenue. How many number of the employee you need and how much you will pay your employees. So you have to take all these detailed assumptions into consideration based on your market research. And by using the bottom-up method, you'll take detailed individual elements and business drivers into your forecast. And these are grounded in concrete and real elements. So based on the information you are knowing, because it's short-term forecast, you can collect more realistic information to form the basis you are forecasting. And the good thing about bottom-up method is that it's very rational and can be analyzed in a timely manner to help you understand what it goes as planned. So you can use this as a monitoring tool to understand the performance of your business So for example, if you expect like the next 3 months, next quarter, you're going to spend 100,000 to set up the office and get your team ready, but end up you spend like 140,000 because you build up from the bottom up, you know, like which part like a delay or you get overspending on certain specific input. So that help you to monitor your shorter term projections. And then move on to a longer term forecast, usually like 3 to 5 years. And as a reminder here, we talked about it earlier, what your investors are looking for. They are seeking for returns, right? So you couldn't just tell them, okay, this is how much money I need, but you are not telling them, well, how my company will go. So you need to present the perspective to your investor that as an entrepreneur, how do you expect your business will go? And so once you begin to generate revenue, set a goal how quickly you grow and when you think you will achieve to a normalized margin. As this is for a longer term perspective, you know that's what you expect to achieve based on your business plan, but you don't have all the details. So that's where the top-down method comes in. Top-down projections are much less detailed. So the starting point here is a bigger picture. So you can work on how big is your addressable market, who are your competitors, and what are their market shares, and then how much market shares you will acquire after you reach your established phase. And I'm not going to go too much detail into this because it's like I mentioned, there's another seminar to talk about to do your market research. But that definitely will help you a lot to understand, like, again, like the bigger picture for what's your goal. So once you have that top line revenue figure out, you can then define how fast you will increase your revenue every year until you reach that revenue goal. And once you have determined the time you need to get that ready, then you know when your first dollar should be coming in and when you should be profitable. And as this is for a longer term picture, you wouldn't have all the information that you need to do like you have in your bottom-up method for the shorter term. It will also take into consideration on whether some of your actions in the shorter term will be successful in the first 18 or 24 months. So you'll also take into consideration of all the things that are happening and that you might not even know of. So it has to be at a bigger picture again, and you need to find a balance between being up too overly optimistic or overly realistic. So that's very important. So taking it separately, both bottom up and top line techniques are far from being perfect. But somewhere between these two projections lies truth of what happened based on the elements available for you. So you have to consider, like, definitely make sure you consider the short-term and longer-term forecast in the pitch book when you share with your investors. And we can move on to the next slide. So when you develop the projections, it's really important to find the right balance again between whether you have enough detail to support your assumption, but not overly detailed so that you cannot articulate your business plan well. So, you know, the first step is developing your projection would be start with some initial market research. First, define the market. What are the end customers that you are planning to sell to? And how big the potential market for your product and services. So that will be your addressable market I just mentioned earlier. Another way to look through is to consider some market research projection for similar companies that have been more successful and use that as a basis to project your own result. And very important as talking to people, if you have any mentors or peers in the same industries with similar companies, that you might be able to ask them for advice of, you know, how revenue has ramped up for them over the time and what key metrics or drivers that they consider when developing their forecast. So think through those key metrics, and Chloe will dive into like some of the key metrics as example in the later session. And identify the key metrics that will drive your business. So you really shouldn't just thinking about like somewhat granular level of how to build up each assumption with your forecast, but very important in your pitch book to have a snapshot of the simple forecast, only including the key drivers. And you might think through like about certain items in more details that might be based to include as appendix in case later on in case if someone asks you those, how your assumption come from, but make sure keep your main deck clean and crisp so that you can, if you can translate that into graph, big font, like just talk through like your forecast. And then if anyone asks you the driver, just put everything in the appendix so that you have all the data on hand. And so that don't break the flow of your presentation. Again, like I mentioned, make sure your presentation to be clean and crisp. And also like it's helpful to have an executive summary in one page to keep all the key driver and focus at a high level. And there's a lot of information behind this, but ideally you want to think of a way to present this larger graph and larger form and keep all the details in the appendix. Like I repeat myself again, because this is very important, and just keep the main deck at very, very high level. So I think this is what I want to cover in the first part of the session, and I will turn it over to Chloe to talk about like some key elements in the forecast.
Thanks,
Chloe.
Veronica. Thank you. So every startup's growth journey can be visualized as a hockey stick chart, as presented in this slide, with slow initial growth followed by a sharp uptick in growth driven by a certain event. So there could be various different events that might suggest a significant increase in growth, such as launching your product in certain stores, getting FDA approval depending on your industry, partnering with a manufacturer. There's certain events that might suggest that your growth in revenue would significantly expand. So while hockey stick growth is great, and it's great to show within your projections that you're optimistic in the growth that you can achieve for your business, it's not easy to achieve, and it doesn't happen overnight. So as such, if you plan to include projections like this in your pitch deck, you should ensure you are able to articulate what is driving this high growth by explaining the underlying assumptions, including items such as what's listed on this slide. So for example, when you're thinking about revenue, you should think about how you expect to grow your existing customer base while retaining your existing customers. In addition, you should be thinking about how you plan to increase your profitability or margins of your company over time by either cutting costs or increasing revenue or pricing. So remember, your growth projections are not just optimistic estimates. They should be based on solid data and strategic planning. Understanding and effectively communicating your projections is crucial for communicating with your investors. The following slides will delve into a little bit more detail on how to build the revenue forecast, and expenses as well. Okay, so this slide shows some of the basics that should be considering when building up a bottoms-up forecast. So as Veronica mentioned, there's two approaches, a bottoms-up or a top-down, and this is more of a bottoms-up approach. So as you mentioned as well, in more mature businesses, you may be able to rely on historical trends to help inform the future. However, for startups, this exercise becomes a bit more challenging due to the lack of historical data and the uncertainties inherent in a new business. As one period you might have significant sales, and the next period you drop off, so it can be hard as startups to forecast. As such, for startups, most of your plan will be based on the new things you're planning to do in the future. In other words, your aspirations. So, it's most important to think through each component of the forecast and to try to have as much detailed support as possible. So really the forecast, I think, can be broken up into two main areas, the revenue drivers and the cost drivers. And again, this really depends on your business. You know your business better than anyone, and what the key metrics are for the business in order to achieve growth. So when thinking about revenue, common minds to think about are volume and pricing. Those are really key elements driving revenue. So, as a startup, you should potentially consider how much customers will be willing to pay for your product or service. And like Anne mentioned, I think there's another training which kind of went over some of those factors. But you should think about how your pricing compares to competitors in order to help estimate a reasonable price for your products. And in terms of sales volume as well, you should think about the overall market size and market share and what growth you plan to achieve. In this example on the slide, this business kind of considered certain items like units sold or number of subscribers. Again, you can vary or customize these inputs based on your business and how you expect to achieve the revenue. So after projecting revenue, typically you would think about the cost of revenue or cost of goods sold. So basically what this is if you're selling a widget, how much money does it take to produce this widget? And typically you would expect that you're selling the product for more than it costs to make the product. Therefore, revenue less your cost of sales should produce some gross profit. So in addition, on the expense side, there's various expenses that you should consider. And again, if you have any historical expenses, that's a good basis to start for the future. However, you have to think about what expenses are needed in order to achieve the growth. So, a key input might be employee headcount. So in order to increase your sales at a rapid rate, you might need to hire more individuals, potentially even sales and marketing professionals, to help get your product to the market. Other items that you can think about are, overhead. Is there any insurance or legal fees or licenses that you need in order to sell your product? So, in thinking about all the various costs that go into your business and to achieving the revenue, that's really what's captured within operating expenses. And when you're thinking about operating expenses, you should think about if each of these costs is fixed or variable, meaning as your revenue increases over time, would you expect these costs to stay constant or to increase at the same rate of revenue? Or you can also consider costs to increase potentially at an inflationary rate over time. So these are some things that you should think about when forecasting operating expenses. And then here, EBITDA, for those of you who don't know what that is, it's earnings before interest, taxes, depreciation, and amortization. This is really a common metric that's used to value businesses. In circumstances where business is not profitable, you might value business based on revenue multiple or other factors. But ultimately, as Veronica mentioned, investors do want to see how you plan to make money in the future. And oftentimes, once you've turned profit, they might value the business based on a multiple of EBITDA. So this is a metric that might be good for you to show in your forecasts. And lastly, here, net income, that's really just an after-tax metric, which shows how profitable your business is and how quickly you might burn through cash. Okay, so let's move on to the next slide. Okay. Okay, so understanding the key metrics of your business is crucial for effective forecasting, as these metrics provide insight into the current performance of your business and can help predict future trends. If you don't have historical trends to assess, you can perform research to see key metrics of competitors or industry metrics for purposes of forecasting for your business. So we'll go through each of them in a little bit more detail right here. So at the top, we have revenue per employee. That's just revenue divided by employees. So this is really a measure of productivity and efficiency for your business. So as I previously mentioned, as a reasonableness check within your forecast, it may be helpful for you to calculate the revenue per employee and compare this metric in your forecast to that of competitors or industry averages. This might be a sounding board, a reasonableness check for what you've forecasted. Next item is churn. What churn means is really the rate in which you lose customers. So really over time, with any business, you will typically lose some customers, but gain additional customers into the future. And you should be thinking about, these types of metrics of how well you retain customers over time. If you have a high churn rate, this might indicate that future revenue would decline unless you're able to acquire new customers at a faster rate than they churn over. So, and speaking of acquiring new customers, customer acquisition cost is another metric that's helpful to observe. So like it sounds, it tells you how much is the cost to acquire a new customer. If customer acquisition costs rise over time, it could indicate that future profits will be lower unless, again, you can increase the value you get from each customer by either increasing pricing or volume by customer. So by monitoring certain metrics like this can help you observe how you've been performing and what changes you might need to make in the future. And lastly here, lifetime value of a customer. So this reflects the total revenue you can expect to achieve from a customer over its lifetime. And this metric might help you determine if you're spending a reasonable amount on customer acquisition costs. So if you spend more to acquire a customer than the value that they bring over time, then you're kind of overspending on that acquisition cost and not realizing the value from those costs. So again, keeping an eye on certain metrics like these can be really helpful in seeing how your business is performing and to help in projecting into the future. Okay, so here are some other considerations that you should think about when forecasting. So, beyond the standard metrics such as revenue and margins, there are other factors that you should consider. So the first one, cash flow. Again, one of the most critical factors to consider is your cash flow. How quickly are you burning through your cash reserves? This should be evident from your income statement and is a key indicator of your startup's financial health and runway. So again, investors want to see if they invest, what you're spending your money on, and you should understand how long that investment will sustain the business based on the cash flow of the business. CapEx, or capital expenditures, refers to investments made towards future growth. So for example, in a technology company, have you made any investments in hardware or equipment? Oftentimes, in order to achieve significant growth, you might have to make significant capital expenditures, and those should be considered within your forecasts. Next, multiple revenue streams. So the prior slide just showed, or prior few slides showed just a single revenue stream projection, but you should think about the different products and services and you know, certain revenue streams might have different growth or margins. And if that's the case, you should be projecting them in isolation. So again, for example, a technology company might be selling software and hardware, and both of those might have different growth rates or different profitability, different cost of goods sold, things like that. And those should be explicitly presented and forecasted. Again, like in, let's say, more of a consumer goods type company, there might be retail options, wholesale options, e-commerce. And again, you should just be thinking through different factors that apply to each of the streams and be forecasting that explicitly. And then lastly here, it's important to, again, we've been talking a lot about thinking through how many units or what it takes for the company to break even. And break even really when the company turns from a non-profitable to a profitable business. So that should definitely be considered when forecasting. And again, understanding these factors and incorporating them into your forecast will give you a more accurate picture of your startup's financial future. So again, remember that forecasting, it's really not an exact science. It's really hard to create a perfectly accurate forecast. But you know, what we can do is try to make assumptions that are most supportable by data. And then we can re-examine and assess our forecasts as we progress to see if we meet the forecasts and tweak them to continue to build a more accurate forecast going forward. Okay, so now that we've told you what to do, a few of the don'ts that we'd like to share. So, you know, you don't need to classify your forecast as a conservative estimate. Investors know that forecasts are estimates and they're not exact figures. Labeling them as conservative may make investors think that you're not ambitious enough or that you're not or that you're trying to lower their expectations. So, you know, our advice to you is to be optimistic and sell your dream, all your hard work that you've been putting into the company, into the deck. However, you know, we want to be optimistic but realistic. And again, based on solid data. Overly optimistic projections might make investors skeptical and question your understanding of the business and the market. So I think it's a little bit of a balance, but definitely don't go with a super modest forecast, for example, that you're going to project negative profitability for 5-10 years. Then investors might think, well, you know, how are you going to make money and why is this worth my investment? So the next one, about don't tell them you only need 1 to 5% of the market. Again, you don't need to be overly conservative in your estimate, but do try to consider the overall market and what a reasonable portion of market that you could sell your products to when you're validating your bottoms-up projections. This next one, don't show projections out 2-3 years. I think that might be a little bit of strong language in this presentation. I think the point there is the further out you forecast, the less accurate your forecast will likely to be. So investors may know this and they might not take the projections past the first few years as seriously, or, you know, think that there's significant risk in achieving anything past 2-3 years. However, you know, I think it is helpful to show when your business turns to profitable. So if that's going to be after 2-3 years, you might want to extend the forecast to show that break-even point. The next point, don't lie. If you know something, say it. So really kind of in any business, honesty is really important, and coming off as honest and reliable. I think investors want to trust that you say what you mean and you mean what you say, and that you're not just saying things to get money, but you're really grounded and understand your business. So don't be afraid to just say you don't know, or to table the discussion, say, can I get back to you on that? And then lastly here, don't be afraid to take advice from prospective investors. So, investors often have a lot of experience and they can provide some valuable advice. So being open to this advice shows that you're flexible and willing to learn, which are really important qualities as an entrepreneur. So, come off confident and strong in your presentation. Again, if you don't know something, be transparent about that and be willing to take other people's perspective and views, as this will come off well in your presentation. Okay, back to Veronica.
Thank you, Chloe. So we talk a lot about techniques and number here because Chloe and I are number people. But think about this. Your pitch book, your pitch deck is really the time to shine. So be confident in your business plan, be confident in your ideas and your growth and your goals. So you want to use the forecast as a way to show your investor that you have your approach to operate the business, and you are just not someone have good idea but doesn't know how to execute or doesn't know how to build a team. So I saw a question in the pop-out here, like how much the VC expect us to get this forecast right in the early days. That's a very good question. And think about this way, this is not an exam. So your forecast is not the way like your investor is going to give you, and you need to get it 100% right, get an A. The way, how much you do your research and you know your business, you know your business plan, and you just present that in a number to show that to your investor, that's actually your investor are looking for. So that show them you have the ability to run a business, but not just have an idea. So think about that way. So your investor are really trying to get a sense about who you are and think what kind of personality you have and you want to bring to the table. And it probably sounds very basic, but you're passionate about your product and your idea. You just want to make sure that coming through your pitch book, your presentation, and you're not just leaving that behind and then just show them the number in Excel or the PowerPoint in your actual presentation. So keep your passion, show your passion, and that's the time for you to shine. So I know we are approaching our time. I want to keep a couple minutes for the Q&A. So I just quickly wrap it up. A few takeaway. So there's no such a thing about perfect deck. Like you learn through each pitch. Every question you got asked, you can add that to your pitch book, your deck. And it's really a work in progress. So don't be super conservative, be optimistic, but realistic. So that's all we have on the formatted content. And I want to have some time, give back, and open up for questions.
Okay. Chloe, do you want to read off the questions? You want me to?
Okay, let's see. Maybe can you, I'm not sure where we left off or which ones.
Okay. I'll start at the beginning. The company to apply to the fast pitch, yes, the company has to be operating and running in the United States. And I don't believe you have to be American citizens, but do me a favor and ping our website expert and she'll confirm that for sure. And then you guys might want to weigh in, how important is social impact to an investor, and how would an investor evaluate the social impact relevancy or aspect of a company for investment?
I guess social impact in what way?
I think when we look at the fast pitch competition, we have seen a trend in the past few years towards companies that are socially responsible or that include that as part of their mission. So yes, they're trying to create a product or a software or something, but social impact and social awareness has become increasingly important, not only to investors, but to consumers. So consumers often look to spend their money with a company that has social values that agree with their own, and hence that would help drive a company's revenues and profits. So I think it is important, and I think it's an important differentiating factor between your company and your competitors. And it is certainly popular now, not only with investors, but also with people buying your product. So the recording.
Yeah, I think that's a good point. You know, like focusing on the social impact that might resonate with certain investors for their own personal reasons, but also again, consumers are increasingly becoming more focused on those types of items. So potentially you might be able to drive premium pricing or get more profits from focusing on that. So you also want to just think of how that social impact translating into the business and the forecasts. And if that drives additional value, that would be good to put in your deck and communicate that you're focusing on that.
Yeah. I think we've mentioned a few different ways that these webinars, this particular webinar, it might take 24 hours or 48 hours to be posted on the Women Founders Network website, but it will be posted. And last week's webinar, I believe, is already posted. So go to the website and look up for resources and on-demand webinars, and you will see this one in a few days and last week's and many, many more. In this current market, how eager are VCs to invest in companies that might take more than 2 years to be profitable? Is there a way to find or assess a VC's attitude about this?
So I can take this one. So from our experience working with a VC, I would say 2 years to make profitable is actually pretty optimistic. And I did see a lot of VC, like they are staying with their investments for longer than 5 years, the company is still not making money. So the key thing VC really is looking at here is the top line. So like how much you can grow, how much you can attract your customers, and can you keep on like your top line revenue grows as you pitch like the in the 2-3 like within one, after you start to generate revenue, how much you can grow. I think that's the key thing they are looking at. And I know a lot of like our VC clients provide advisor services to their entrepreneur as well. So they'll help you to achieve your goal, but build up the network and link you to other people in the industries. So definitely, I don't think looking at the bottom line is what they are looking for, but it's important because that will tell them how much cash burn, like we keep mentioning, like the cash runway you have through like different round of financing. And if you have that potential, like the VC, like your VC owners will help you to go through like different round of financing, but you definitely need to show your growth perspective.
Yeah. And you can also try to find out what the VC has invested in the past. Make sure that you're in line in industry or whatever with what that VC tends to invest in. Otherwise, maybe you're just not meant to be part of their portfolio. Maybe you should go elsewhere. Or if you look similar to what they've invested in, then you might be in the right place. How do you assess your possible market share?
Yeah, I think it's mainly you just have to think like kind of macro and then keep narrowing it down. So, you know, first think about the industry you're in, the geography that you're in. And again, there's various industry reports that kind of discuss the overall market for certain products and services and how much revenue the industry generates on an annual basis. But like, again, what industry are you in? And, you know, are you marketing to just women? Are you marketing to women that are 18 to 35? Are you, and you kind of start big and like continuing to narrow down. And there's various industry reports, like I said, that you can do some research to kind of understand how big the market is for those types of products. So that would be my recommendation.
Okay. We had a couple of questions about lifetime value of a customer and customer acquisition cost. I think the deck has those formulas. And I think they're pretty well explained, so
Maybe like one example is like, so you're wondering like, well, what's the cost to acquire a customer? Like you could look back in history and say, hey, I spent X amount on marketing to these customers, and how many customers did you actually purchase your product after that marketing? So that would, if you take the amount of marketing divided by the customers that you gain, then that might be the cost to acquire a customer. So those are an example of a way to think about it.
right. And there's an additional question on that that says, well, it's going to be a lot of guessing at the start. And yeah, if you don't have any customers today, then first of all, your customer acquisition cost is probably going to be pretty high because nobody knows who you are. And so it's just important for the VC to understand, as Veronica said, your thought process. How are you thinking about this? Are you the expert in this area? And then, by the way, even if my customer acquisition cost today is way up here, I know how it's going to come down so that it makes sense for me to go after those customers. What figures are you using in cost of revenue versus operating expenses? Can you guys describe the difference between those two?
Yeah, again, cost of revenue is like, okay, let's say I made a product, like what are the materials that take to make that product? So in order to sell that specific product, there are specific materials to make that, or labor required to sell a product or service. Operating expenses are more like overall business expenses that are, headcount, overhead, any other legal or finance fees, anything like that. So operating expenses are more general, and cost of revenue is really specific to the product that you're selling.
Okay. A question regarding CapEx. Do either of you normally see the firms you evaluate outsource their product creation to lower their costs before they start making revenue? So are you seeing a lot of outsourcing or building your product or spending CapEx internally?
I don't know if it's, to be honest, with KPMG, I personally work with a lot more mature companies, but I think it's really depends on what works best for your business. If it makes sense to spend time manufacturing the product internally or outsourcing that to manufacturing firms, just got to evaluate what the cost is in either circumstance and pick the route that works best for you. Veronica, I don't know if you have any other specific experience.
Yeah, so I think it really depends on what kind of product you are looking for. And like, I know some, and then how you define your product in the market, right? So I know like some companies, they are trying to looking for like even offshore outsourcing with a cheaper price to manufacture, that they can get bigger margin if they have the resource. But again, if they are going to like market their product, okay, everything is manufacturing in US, you don't want to do that, right? So it really depends on what industry you are in and how you want to define your product. And then if you have sufficient resource in-house to do the work, right? So if you are going to build up a website, but you don't have any like skill set, you do it in-house, you probably need to hire someone else. So it's a very challenging question. So it's really depends on like, what kind of product you're going to create.
I would say that in the Fast Pitch group of people that have applied, we see in their initial stages for a consumer product, a physical product, one that you can pick up, they're outsourcing because they can't yet do the volume to bring their cost of production down. So they're finding an outside vendor to create the product. But I say on the tech side, they usually have someone on deck who is able to create the code and do the production of software within the company. Let's see. Are you also considering film production companies seeking funding? I think maybe you should go offline and ask that directly of the website, and we will absolutely get back to you. Production companies, as you know, wow, they're changing so quickly that it's a very, very challenging market. So maybe give us a few more details. And if you're asking about the fast pitch, we can get back to you as to whether or not that is the type of fast pitch entrant that we're looking for. Ladies, for valuations, are price per share or equity value estimates ever included in the financials or solely a 2 to 5 year projection?
The share price included within the financials. I mean, typically, no, that's not included unless your your financials include stock-based compensation, which you're valuing the shares of the company. But I mean, typically, we're not presenting an actual share price in financial statements.
Okay.
Especially you are in the early stage, right? So it's very hard to provide. So in order to have the price, you need to know what's the valuation of the company, right? So I think it's very hard, given that you are more like the cost spending phases. And the way I think that's connect to another question later on is like, in terms of the valuation, like the way VC look at the value of the company, it's very high level, especially for the venture capital. And they probably look at similar company, like think big, right? So if you are doing an online marketplace, just pick a public traded company that you would think about, okay, that's what I'm going to, like, that's my dream. I want to achieve to become an Amazon 10 years down the road. So the way VC probably look at the valuation of the companies, they will see, okay, within the 10 years, how much you can grow your revenue, how much market share you will get, and then look at the revenue multiple. So you can see what's the trading revenue multiple for Amazon and think about like what's your projected revenue 10 years down the road. That's pretty much the VC look at the valuation of your company, but definitely they will take quite a lot of discount because not everybody can become Amazon down the road.
Okay. We had some more fast pitch competition questions. And yes, we absolutely have probably half of our top 10 each year are pre-revenue, but they do have a demo of the product or an MVP. They're not just at the idea phase. So maybe they say, I want to develop this phone case wallety thing, and I have, a demo of it or a pre-production model that I have out to 40 different people to give me their feedback, but they're beyond the idea stage. And maybe if it's a tech company, maybe their MVP is not fully functional. Maybe it has partial functionality, but they have some customer feedback on, ooh, this is what I liked about it. This is what I didn't. So you do need to be beyond just the idea stage, but you can still be working on your MVP and have a pre-production model of your physical product or a piece of your app that works, but not maybe the whole thing, not all the bells and whistles, and you're collecting customer data on what it is. Again, reach out to us and give us 3 or 4 sentences on here's where I'm at, and we can tell you whether or not that's in line with what we're looking for. And we get back to you within a couple of days. So I think that's about all the time we have today. And Chloe and Veronica, wonderful, wonderful presentation. I'm so happy that you guys were able to come out today. This recording will be on our website before the end of the week. And we have many, many recordings to come, webinars to come on cap tables, term sheets, LOIs, and things that will just make your head spin in a positive way. So I hope you join us for our future webinars and reach out. And if you have specific questions on this topic, we will be able to track down Chloe and Veronica and try to get those answered for you. So thank you, everyone. And thank you, ladies. Wonderful, wonderful job.
Thank you. Bye.